be an opportunity for us to reflect on whether we can go further through the supply chain in a competitive manner. But we are part of a global community. We can't run away from that. We're only a nation of 25 million people. We've got to understand our place in the world. We still need to trade, and so it's important that we create wealth, and we have created wealth through the trade agreements we've got, but we do that in a cost-effective way that it gets efficiencies, but also protects our national security, which we've done with underpinning our food security. Agriculture, in fact, has been the bedrock of our nation's security over the last 2 months through this, because it's underscored our food security, which has kept our national security in check.
Farmers in Australia are just reeling from the recent bushfire season, which was devastating for parts of the country. How has that kind of been compounded by this latest crisis, the shutdown that we've seen across various services industries? And how quickly are you seeing a recovery, particularly from the likes of China as it begins to reopen? Is there still demand for Australian products at this point?
There is, and in fact, I've got to say, we're a tough mob. Our farmers, we had floods just on 12 months ago, unprecedented floods in northwest Queensland. We've had drought, then we hit fire, and then COVID-19. And our farmers have just kept on going. And in fact, there's an air of optimism. We've had some rain, and the psychology of farmers and regional communities in Australia changes on a dime. You get some rain, and the psychology of the place changes overnight. No matter what federal governments, we put $8 billion into drought support. The one thing that beats that is this thing called rain. We need more, but we are set to have a reasonable season, but we've got more work to do.
Minister, thank you very much for your time today. Australian Agriculture Minister David Littleproud joining us from Queensland. And we have an alert on the Bloomberg. President Trump saying that he has heard the report on Kim Jong-un's health and that he thinks those reports are incorrect. Of course, we had heard that Kim Jong-un had undergone a serious medical procedure. Daybreak Asia is next. This is Bloomberg.
Here's the thing about managing multiple clouds for your business. Things can get a bit cloudy for you. But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Here's the thing about managing multiple clouds for your business. Things can get a bit cloudy for you. But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
in San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market, which is down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the First Word Asia.
The U.S. and Japan duke it out over exchange.
China's slumping onshore bond market is great.
Welcome to Daybreak Asia. I'm Sherian in New York.
And I'm Heidi Stroud-Watts in Sydney. We are counting down to Asia's major market opens. Our top stories this hour. Asian markets face an uncertain session after reports that a leading coronavirus drug has tested poorly. Futures fell in Tokyo but rose in Sydney and in Hong Kong. And oil maintains its slow recovery after a wild week. Futures gain in New York, but traders are still concerned about the swelling global glut and the lack of storage. And skies are darkening over Japan as the coronavirus prompts its dimmest view on the economy for a decade. We have the inflation figures out this hour.
And we have breaking news at the moment. We are hearing from Treasury Secretary Mnuchin saying that the U.S. has no current plans to create a Federal Reserve facility to inject funding into non-bank mortgage servicers. This, of course, as we have seen recent government moves to help the firms get through the risk of millions of borrowers missing their mortgage payments. Again, Treasury Secretary Mnuchin saying that he has no plans for mortgage servicer lifeline. Right. Let's now bring in our congressional government reporter, Emily Wilkins, on the line for more on what we heard from President Trump as well as Vice President Pence on the latest efforts when it comes to handling the impact of the coronavirus pandemic. Emily, so Secretary Mnuchin saying that he has no plans for mortgage servicer lifeline. He says that the steps are taken by agencies have eased liquidity concerns. What else are we seeing in terms of government action in order to try to mitigate the impact of this pandemic?
Absolutely. I think one of the biggest stories coming out of Washington, D.C. today is actually over in Congress, where the House did pass a $484 billion coronavirus aid package. A lot of that includes funding to help out small businesses. Remember, the funding for a lot of them ran out about a week ago, and lawmakers have been under immense pressure to come up with more funding. It also includes funding for hospitals, for vaccines. And so that is a big thing that is now passed Congress and will go to the president's desk to be signed. But Congress is already starting to work on yet another bill, knowing that there is still a lot of pain going on in the economy at the business level and the individual level, and seeking to address that.
And of course, we're already looking ahead to subsequent bills, right? As you say, what more assistance and aid do we expect in these packages that are already being discussed?
Well, one big debate going on in D.C. right now is a debate over how much should be given to states and localities. Yesterday, you saw several Republicans, including Majority Leader Mitch McConnell in the Senate, coming out and saying that if states aren't able to continue funding, they might need to declare bankruptcy. That's something that a number of governors have pushed back against, saying that they need help from the federal government at this point as well. So that is definitely a debate to sort of keep your eye on going forward. I think there are other things to see, whether we're going to see policy on how elections will run in November, whether we're going to see another round of stimulus checks. These are all debates that will be had, and certainly we saw the last package pass was in the trillions of dollars. That means that I think a lot of lawmakers are seeing this upcoming package as a potential to perhaps get some of their most important items into.
Emily. Thank you so much for coming on with us. Emily Wilkins, our congressional government reporter there. Let's get you a look at what kind of session we're setting up for here in Asia on this Friday. So if your Cameroonians in Hong Kong, so pretty mixed outlook here.
Yeah, this Friday we are looking at a mixed start while we have U.S. futures under pressure as investors perhaps are assessing policymakers' virus responses, which will come with funding pressures. And we're seeing a resulting pickup then in debt issuance, not just from corporates, but also from sovereigns. The U.K., for example, set for record bond sales. And we're learning that South Korea is likely to issue government bonds to provide cash handouts to all households in the country. The Seoul Economic Daily reporting that up to 3 trillion won government bond issuance would be needed to provide for that. And today we're going to get more clues on the health of corporates in the region. We have a heavy earnings lineup, including from POSCO and Kia Motors in South Korea, as well as Advantis and Fanuc in Japan. Ahead of that, we have Nikkei futures in Chicago under pressure, while the yen is just holding on to a 2-day gain this morning as we wait on inflation figures due at the bottom of the hour, which come ahead of the BOJ's policy meeting on Monday, during which the central bank is expected to discuss QE. And flipping the board to check in on oil prices this morning, we are seeing WTI gain ground. Front-month prices holding above $16 a barrel, after actually above $17. This after a 2-day rally, which has paired oil's weekly decline with production cuts in focus. Sherry.
500 is the most dependent on big tech in decades. We assess the sector outlook with Wedbush's Dan Ives. Plus, Asian stocks have dominated other emerging markets this year. More on why now could be a good time to buy. This is Bloomberg.
Here's the thing about managing multiple clouds for your business. Things can get a bit cloudy for you. But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience. Here's the thing about managing multiple clouds for your business. Things can get a bit cloudy for you. But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
You're watching Daybreak Asia. I'm Karina Mitchell with the First Word headlines. Global virus cases continue to rise, although there are more signs of easing in some areas. However, world leaders are being criticized. ECB President Christine Lagarde told a virtual EU summit that governments have done too little to stem the virus, and what they have introduced has been too late. U.S. cases rose at the slowest pace in 3 weeks, while Spain reported the most infections and fatalities in a week.
The public must understand the inherent risks as governments, understandably, try to release the steam building up in societies and pressing our respective economies. This is not an exit. There is no fast track to the new normal.
And the EU economy slumped this month as coronavirus restrictions hammer companies and jobs and leave the single market struggling to stay afloat. An estimate of private sector activity plunged to 13.5 from 29.7 in March, far sharper than forecast and the lowest PMI reading since records began 2 decades ago. The data suggests the economy is heading for a sharp and lengthy recession. Meanwhile, the UK is seeing the price it may pay for the virus lockdown as output shrinks at the fastest pace in decades. Current and former Bank of England policymakers say the outlook for jobs is, quote, horrendous, with a quarter of the labour market already effectively out of work. UK output contracted this month at the fastest pace in 20 years, but Bloomberg economists say that may still understate the damage. And Japan has a bleak view of its virus-hit economy, saying the prospects are the worst since the financial crisis. Japan says the situation is, quote, extremely severe and worsening rapidly as it cuts forecasts for a second straight month and downgrades consumer spending, factory production, corporate earnings, and jobs. Nikkei says the BOJ will discuss unlimited government bond purchases when it meets on Monday. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Heidi.
Well, Karina, more than 4 million people filed for jobless benefits in the US last week, bringing the total in the 5-week virus pandemic to more than 26 million. And the extraordinary rate of applications may continue to several more weeks. Narita Kohler is the MD and Head of Advice at Dixon Advisory. Narita, we saw stocks really pretty volatile overnight. When you look at data like this, that the numbers, seem to have passed a peak, but cumulatively you're talking about 26.5 million people in the US out of a job just over the past month or so. What does that mean in terms of expectations that as bad as this is, perhaps we've seen a levelling out for now?
Good morning, Heidi. Well, there's a long list of pretty jaw-dropping data just in the last 24 hours. The service and manufacturing data around the globe, the US unemployment that you spoke about as well. We could keep listing them, but the message I think that markets are taking is that we will recover. And that's being driven by confidence from declining spread of the virus, the government support packages, and the central bank actions that are helping economies get through this. It's just a matter of how quickly we will get through this.
In the meantime, though, are we still seeing, pretty expensive pricing across equity markets, particularly as you consider it's an inevitability that a global recession is going to happen, that, yes, policymakers and central bankers are throwing, whatever they can at the problem, but we are going to be in for a period of pain, particularly when it comes to the demise of the demand side story, right? So would you still be pretty highly selective in this pricing environment?
Heidi, I think that's spot on. Market pricing is certainly on the optimistic side that, that it will be a rosy path out of this crisis. And that's where investors do need to be, quite careful, because while from a macroeconomic position, we can look over the horizon and we can see, a pickup in, say, 2021. What we do know on the ground is that, some companies won't make it through. And I think the fact that, many companies can't provide financial guidance tells us something very important, that they're not actually clear about how much impact they'll actually have to bear. And so that is where we do need to be very conscious as investors of looking for high quality companies and really trying to make sure, from good cash levels, manageable levels of debt, good management team, that structure that the company has got and their balance sheet is going to give you the best chances that that company is going to be around for long term, because you might not see much upside in the next 12 or 18 months or whatever that window is while we're recovering. But over the long term, if you can get a good quality company at a discounted price, then obviously that could be very valuable. But investors also need to be careful about buying on yield, because we do think there's a high risk of downgrade, and that some of those have yet to really work their way through in terms of the pricing that's on offer. So there is a lot of things for investors to consider at that company-specific level as well.
So where would those high-quality companies be? Because we continue to see U.S. stock volatility exceeding volatility in emerging market stocks, which sort of points to perhaps option traders at least being more optimistic about the prospects in emerging markets than they are about here in the United States.
Yeah, we've probably got, a little bit more of a cautious outlook on emerging markets. We do think a lot of the, impact is still to flow through to the emerging markets. Right now, because the market has picked up over these last few weeks, it is tough going. It's tough going to get in there and find these good quality companies that have not already been bid up in terms of prices. And I guess where we're looking at the moment is actually back in Australia. For Australian investors, that offers some good opportunities there. And I think there's a couple of things going for it generally, is that the fiscal position of the government in Australia is in a better position to be able to handle the massive stimulus that they have actually provided. We've got a very good level of coordination between the government and the Reserve Bank, our central bank, and state governments working together to really try and come out of this with policies that will help the economy go well. And therefore, we've sort of drilled down a little bit there, and we do think there are some opportunities still there. Companies like Macquarie Bank, National Australia Bank, the pricing at the moment we think is actually quite attractive. Sydney Airport and Transurban have been hit quite hard. If you're prepared to invest for the long term for those companies, we do think they are well structured for a recovery. And even on the defensive side, companies like Metcash can offer some upside there for investors. But you're right, it is very difficult because everybody is looking for those high-quality companies. And what we're seeing on share markets and in the US as well is quite a divergence. We're seeing, a few sectors doing very well, health and tech, and other sectors lagging behind a little bit.
You were talking about Australia, but of course this economy very dependent on what happens in China. Given that they went through the coronavirus pandemic before anybody else around the world, could we see a little bit more upside and opportunity in their stocks as well?
That's right. So you're spot on. Obviously, Australia is being heavily reliant on China. China's really our number one customer in terms of our exports. And we're seeing that, as China really leads the way out of the shutdown in terms of their policies, that there has been a pickup in some of their industrial production and some of their numbers there. What is a little bit concerning is that the consumer confidence and the propensity to spend hasn't quite picked back up to the levels that we would like, and that's understandable. And that is also something we would expect to see in other global economies as they work their way out, that even when the economies reopen, households naturally are going to want to feel a high level of confidence about their future income prospects before they go out and spend. But there may also be some behavioural changes for consumers that actually mean they start saving more and spending less. Now, if that continues in China and doesn't pick back up, then it could actually be a slower pathway to recovery than we've perhaps hoped for. And that could have some flow-on effects for Australia. But at the moment, we're still hopeful that that recovery in China will continue and will give some opportunities for Australia in terms of our exports.
So a permanent shift to consumer behaviour is one of the things that we have been discussing at length, but I'm wondering what other structural changes you think might come out of this in the post-pandemic period, and I suppose what opportunities, what interesting companies you think there are in stocks that would take advantage of these shifts?
Well, on the first part of that question, yes, we do think there's perhaps a little bit more of an opportunity here for some structural reforms. And I think over the last, few years, we've had, the Australian Central Bank, the Reserve Bank calling for, structural reforms. We've had at a global level, the IMF, been a regular complaint from their point of view that central banks are being relied on too much to do the heavy lifting around, keeping economies going and really wanting governments to do some of that big picture reforms. Now, what's happened in Australia over this last 6 or 7 weeks is we actually have had a very cohesive government at state and federal levels working together, and they've really shown a capacity to work across the traditional divisions to get things done. And there is some hope that this momentum and policy cooperation might actually continue, at least until the deferred federal budget, which is now back into October 2020, and perhaps provide a platform for reforms out of that. And the sort of structural reforms we've had are, reducing red tape, tax reform, increasing measures to increase productivity in the labour force. So those things can make a big economic difference. When we talk about, I guess, from a societal point of view, we've seen, and I just think this has been talked about quite a lot, obviously, speeding up of some of those existing trends, online retail, working from home, and that's been reflected already in this, the bidding up that we're seeing in the tech space as well. So those are the sort of things that we're watching and thinking about in terms of the impact from a longer-term economic perspective.
Narita Cole, thank you. Dixon Advisory joining us there on the line. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers, go to DayBgo on your terminals. This is Bloomberg.
Here's the thing about managing multiple clouds for your business. Things can get a bit cloudy for you. But now, there's the Dell Technologies Cloud.
A single hub for a consistent operating experience.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil, the Bloomberg Commodity Index.
Analysts are reducing earnings estimates for emerging markets at half the pace of the United States. It's a bet that American growth and corporate profits will take a bigger hit from the pandemic than developing nation peers. Senior editor and Bloomberg opinion columnist John Author says EM stocks may lead the virus rebound. He joins us now on the line. John, so usually when we see a lot of uncertainty, when we see fear, it's mostly emerging markets that see this huge capital outflows and suffer. So what makes you think that EMs will actually benefit more coming out of this pandemic?
History, I suppose, is the one-word answer to that. Generally speaking, you're quite right. They get it worse on the way down, and partly because of that, they also do better on the way back up. Now, you've also got to look at the fact that we have had very interesting differentiation between emerging markets in a way that we haven't seen in previous sell-offs. If you look at emerging market Asia, China and the countries immediately around it, they've done considerably better than most of the developed world. And if you look at the rest of emerging markets, particularly Eastern Europe and Latin America, they've done terribly. and are plainly at levels that are very near the floor at this point. So you do have to differentiate as well. The EM as a whole wasn't as badly hit as on the way down as it normally is this time, but that only applies to the specific factors that China and Korea and Taiwan are believed so far to have done a better job of dealing with the virus than many of the other countries that came later.
John, as you say, in this and every other circumstance, not all emerging markets are created evil. Is that, equally, I should say, is that sort of even more the case in this situation where you've got an exogenous shock, which perhaps means that history is not as useful in terms of telling us what will happen next? And also, each of these countries are handling the healthcare crisis and the economic shutdowns in very different ways.
That's certainly true, but you've got to remember that we're living in a world that's come to be dominated by passive investments, that flows tend still to be fairly undiscerning in the way that they move. And again, basically, when you take a look at the flow data, China and the countries immediately around it have actually survived quite well, and the rest of the emerging world has really been starved of capital in a quite dramatic way in the last few months. And that's, if we're talking about the behavior of prices of securities, that's probably going to matter more than anything else. The other point that can be made about emerging markets as an asset class, when you look at it that way, is that they're diverse. That you've got a range of different countries which have their own idiosyncratic problems and benefits, and that gives you some kind of diversification within emerging markets.
John, always a pleasure having you on with us. John Authors, a senior editor and Bloomberg opinion columnist there, making the case for an EM rebound. Let's get you a check of the latest business flash headlines. Boeing is set to slash 787 Dreamliner production in half and cut jobs when it announces earnings next week. We're told that final details are still being discussed, but the company is under increasing pressure from the virus-led collapse in air travel on top of the grounding of the 737 MAX. Dreamliner output began the year at 14 a month. Boeing aims to drop that to a single-digit rate. Emirates and Etihad are resuming passenger flights to limited destinations in Europe, Africa and Asia, although only citizens of destination countries and those approved for entry will be allowed to board. In-flight services will be modified to reduce contact and passengers must wear masks. The flights are aimed at flying out foreign nationals and bringing citizens and permit holders back home. Top Indian carrier Indigo is rolling back mandatory pay cuts, saying it now won't cut salaries this month. The airline had announced company-wide reductions in March, in line with the government wishes. CEO Ronojoy Dutta says now all staff will receive full pay. However, the executive committee and senior staff salaries will still be cut, but only voluntarily. Well, coming up next, we will be joined by the Wisdom Tree Japan CEO Jesper Koll. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud.
A single hub for a consistent operating experience.
And we are waiting for those inflation numbers out of Japan. We are getting the fresh, excluding fresh food, core CPI prices year on year for the month of March coming in at growth of 0.4%, which is a deceleration from the previous month, but in line with estimates. When it comes to the national headline inflation numbers, year on year 0.4%, in line with the estimates, and also same pace of growth as the previous month. Core inflation, excluding food and energy, growth of 0.6%, as expected for the month of March. Again, excluding fresh food, year-on-year growth of 0.4% for inflation. Of course, we had expected easing of CPI prices, given that we are seeing pressure from lower energy, also weaker demand because of social distancing, as we continue to see Japan handle the ongoing coronavirus pandemic. Right, joining us now from Tokyo is Wisdom Tree Japan CEO Jesper Kohl. Jesper, great to have you with us. Really not surprising when it comes to those CPI numbers out of Japan. Bang in line with estimates, but still a deceleration when it comes from the previous month for core prices. Having said all of this, of course, we're still far, far away from that BOJ 2% inflation target. Has the pandemic, though, sort of lessened the significance of these inflation numbers, not to mention the oil crash, of course?
You're absolutely right. Inflation, the 2% inflation target is almost the last thing on the Bank of Japan's mind right now. Everybody's working overtime, to get those new lending facilities out to the small and medium-sized companies. So it's not about the inflation numbers. It's all about the economic support for small companies.
Jesper, we have heard local media reports in Japan talk about the BOJ discussing unlimited government bond buying, replacing their current 80 trillion yen target. What are the implications of this, given that we already know they've done plenty?
Look, basically, this is a wonderful gesture, from the Bank of Japan, lifting the 80 trillion yen cap. Now, remember that technically the Bank of Japan is actually just targeting zero interest rates for the 10-year bond. And whether that takes, 20 trillion yen or 70 trillion yen, it doesn't really matter. Right now, there's a lot of pent-up demand amongst the Japanese banks, so funding the additional fiscal stimulus here in Japan is really not the problem. The more important thing about the Bank of Japan is the increased commercial paper and corporate bond buying that they're likely to be discussing on Monday's board meeting.
Yeah, and I want to throw up this chart taking a look at where we're at when it comes to BOJ holdings of Japanese government debt. We're over 40% at this point. This chart shows insurance pension funds hold about another quarter. Just about 3% are held overseas. So, there's obviously no doom, gloom over the debt burden and the risks associated with that because it's so domestically held still at this point. But, does it make a difference at this point, given how extraordinary we are on the spectrum of extraordinary monetary policy that the BOJ can execute?
Look, it does make a difference in the sense of that it just confirms that they'll do whatever it takes. But as I said, the key point, this is obviously true around the world. The key point is not so much ring fencing the financial system and financial stability here. That's important, but much more important than the new element of this crisis, obviously, is getting the support out to small and medium-sized companies. That's where the Bank of Japan, has more work to do.
We are expecting maybe some more measures when it comes to corporate funding, right? But beyond that, they don't really have to do that much as long as equity markets and the yen remain pretty stable.
You're exactly right. The key point obviously is the next leg of policy, fiscal policy. Prime Minister Abe and his team, not just announcing, record-sized budget, but actually delivering. And again, it's the nitty-gritty stuff. It's all very nice and well to say that a small and medium-sized company is going to get government support. How many forms do you have to fill out? how quickly can the money actually get to you? Because basically, Japan, like everywhere else, small and medium-sized companies are running out of time. Meeting May payroll is going to be very difficult, for many companies.
We have seen Japan, of course, have a very tight labor market for quite some time, but we continue to see this employment shock here in the United States with the coronavirus outbreak really intensifying, it seems, a second wave taking place across Asia. What will be the labor market impact in Japan?
Look, the Japanese labor market is very different, much more rigid, than the hire and fire stuff that you've got in the United States in particular. So, yes, the unemployment rate is expected, to increase, currently around 2.25%. That's likely to peak out possibly even at around 3.5%. So nowhere near the sort of 12, 13, 14% that people are expecting in the United States.
Jesper, I was in Japan during the Fukushima nuclear crisis, and the expectation was that perhaps we could see some more coherent policy coming out of politicians, that there would be a movement to really reform. That did not necessarily happen. What can we expect this time around? Could we see any progress on the third arrow of Abenomics?
I think the answer is yes, and you're actually seeing it in small and little things. Let me give you a concrete example. The Japanese Doctors Association had refused, televisitation. So you couldn't, dial in and get, video, diagnostics. Now they've allowed to do that. They've also allowed, believe it or not, to have prescriptions, that you don't have to pick them up by going to the hospital, but you can actually get the prescription via a fax machine. So that's huge progress, in terms of doing away with some of the sort of slightly opaque rules and regulations that Japan has had.
Yes, but I'm going to take this conversation back to where we started with those, kind of meh inflation numbers, right? With the plunge we've seen in oil, does this pretty much kill those inflation or reflation ambitions for the Bank of Japan? And how much of a dent does, the psychology, the kind of reflationary psychology, the consumer mindset take with this pandemic-related shutdown and cancellation of the Olympic Games, or I should say postponement of the Olympic Games?
Oh, look, I mean, it's pretty clear that, the Japanese consumer price index, in 3 or 4 months is likely to be back at, around -0.5% to -0.75%. I mean, there's no question, where things are going to be going. Part of that obviously is good deflation in the sense that your energy bill, your food bill is going to be coming down. But, all of this inflation talk has now been superseded by the worry about jobs, income security, and quite frankly, just the outlook for the overall system.
All right, Wisdom Tree CEO Jesper Kohl there with us. Appreciate your time as always. Let's take a look if we're seeing much of a setup in these markets. Of course, pretty mixed expectations across the board. So for this Friday.
Well, focusing on Japan, we're seeing little reaction to those CPI figures from the country, given how the focus is just on how policymakers will provide credit using targeted measures to companies. So this morning, we're seeing Nikkei futures in Singapore open lower, while U.S. futures are under pressure as well. And the yen just holding steady, trading at 107.62 after retreating overnight from the 108 level. So holding a two-day gain then as investors assess the impact of bond buying by the BOJ. Mizuho Securities chief market economist, he says that the current 80 trillion yen target that has long lost substance, and SMBC saying that unlimited QE, the actual effect of that measure would be marginal. And checking in on JGBs, they settled higher, so we're expecting a gain for Japanese bonds ahead of the BOJ's buying in the long end of the curve, the 10 to 25 year zone. That's what we're going to see buying today. Sherry.
Right, coming up next is earnings season in the middle of a global pandemic. Coming up, we'll get you a preview of all the big tech earnings next week. This is Bloomberg.
Here's the thing about managing multiple clouds for your business. Things can get a bit cloudy for you. But now, there's the Dell Technologies Cloud.
A single hub for a consistent operating experience.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
There is a part of this which you simply have got to rise up and meet. And it's a battle that has to be fought. The emotional roller coaster for me is not an insignificant one.
This is Daybreak Asia. I'm Karina Mitchell with the First Word headlines. The House of Representatives has overwhelmingly passed a $484 billion coronavirus aid package, even with lawmakers at odds over the next rescue bill. The debate saw members wearing masks and entering the chamber under strict health precautions. President Trump is expected to sign the bill, which is the fourth virus-related spending package since early last month. Meanwhile, Malaysia is extending its virus lockdown by another 2 weeks to May 12th, while easing restrictions on limited travel. The government says students and workers living in dormitories will be allowed to go home, but further nationwide curbs may still be imposed. New infection cases have slowed since Malaysia introduced strict limits on personal and business activity on March 18th. And oil continues its recovery from dramatic sell-offs this week, although the global oversupply still sees huge amounts of crude looking for a home. Futures gained 20% in New York, with U.S. production now at its lowest since July. Some OPEC nations have instigated output curbs. Kuwait says it's rolling back production, while Algeria has also said pumping will be reduced immediately. And the coronavirus has hit Hollywood. Film production has collapsed from more than 1,000 shoots in February to 0 last month. And the LA Film Office can't say when the cameras may start rolling again. The shutdown is crippling the local economy, where about 1 in 5 jobs is tied to the entertainment industry. As well as movies, more than 40% of scripted TV shows are usually shot in Los Angeles. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
Karina, thank you. The performance of the S&P 500 is becoming even more dependent on its 3 most valuable companies. Microsoft, Apple, and Amazon have increased their weight within the index 3.3 percentage points for the year so far. By itself, the increase exceeded the weight of 3 of the S&P's 11 main industry groups. Joining us now is Wedbush Securities MD of Equity Research, Daniel Ives. Dan, great to have you with us. So, it seems that during this pandemic and so much uncertainty out there, at least the FANG names are being seen as a safety call.
Yeah, I mean, the FANG names are really almost viewed as safety blanket names in terms of this environment. I think part of it is they're stronger, getting stronger. If you look at the secular trends, you look at Amazon on e-commerce as well as cloud, a massive secular trend that's given them tailwinds, as well as Microsoft. You know, and that's another one. And I think when you look at FANG overall, you know, from Alphabet even to Facebook, and you saw with Netflix, you had Microsoft in there. I mean, the stronger getting stronger. And it's a bifurcated market because while they're seeing tailwinds and you've seen the stocks fold up, I mean, it's going to be an earnings season for the ages, not in a good way. You know, it's just going to be an ugly tech earnings season over the next few weeks, and I think investors are bracing themselves for it.
Especially with Apple, right? Because it seems to be being hit both from the supply chain side of things and demand as well.
Yeah, Apple is in the eye of the storm. on the supply chain, especially everything that we've seen throughout Asia and just delaying smartphone production. Ultimately, we believe the 5G iPhone 12 gets delayed somewhere into the November, December timeframe. But with that said, demand, they're in the eye of the storm. And you see that. I mean, iPhone numbers, our recent checks coming out of Asia this week show about 15% cut to iPhone. But this is another one where investors, they're looking through the next quarter or two on the other side of the dark valley. That's how the valuation is really more off our 2021 numbers and more off of what's going to be a delayed 5G cycle. But that's why with Apple, a lot of focus on what Cook says about the 5G cycle, as well as just how bad demand is. And clearly, we think, these 15% cuts to iPhone units.
Dan, out of the other side of this, which of the disruptors in tech will get disrupted themselves? We've talked about whether there's a long-term, future for companies like WeWork. There's some serious question marks over Uber and Lyft as well. But what are you seeing in terms of these structural changes that may take place once we get out of the lockdown, but some of these things will kind of be in place for a long time to come?
Yeah, on the other side of this, we talk about the strength in some of the FANG names. On the other side of the spectrum where the gig economy plays, they're really ones where the business model is going to be altered on the other side of this. You're talking the private side, Airbnb and others, but when you look at Uber and Lyft and just ride sharing, safety, will customers be comfortable getting into cars, just given the COVID-19 pandemic. And so I do think you're going to see consolidation on the ride-sharing side. I think you're going to see private companies that potentially could have gone public now maybe get consolidated. So I think that's where in the gig economy, that's really where the significant gut punches to those business models, which might be altered going forward.
How much of a hit does R&D take going out the other side of this? Because there's been some criticism or just sort of commentary on the fact that Uber has kind of missed the window of opportunity for investing and progressing autonomous driving while Google has gotten ahead. And now it's probably not likely that it will ever be able to catch up.
It's a great question because when you look at Waymo and everything that Alphabet's done, clearly they're in the driver's seat when it comes to autonomous. And when you look at Uber, more and more pressure on that business model in terms of some of the prospects of profitability and just R&D, and you're going to need to see cuts. Now, obviously, autonomous, when you look where Uber plays, that's a big initiative. But it comes down to right now on the whiteboard, if there's 5 things that Uber is looking at, they're going to have to cut 2 or 3 of them. Just given what you're seeing with the top-line growth, just to give some numbers, we cut our numbers by about 50% for Uber this year in terms of ride sharing. So it's just dramatic cuts, and I think that's going to be something in the coming weeks. Investors really focus on Uber and Lyft just to get some more granularity on the comfort of what that trajectory looks like.
When it comes to Amazon, we have seen, of course, significant demand given the need for supplies and essential products. But at the same time, it seems that we're seeing more pushback against this giant. France shutting down their warehouses because of safety concerns over their employees. Is there going to be a fundamental shift after this pandemic is over about how regulated Amazon gets?
I think for right now, Amazon is clearly benefiting from an e-commerce really becoming the core artery, both in the U.S., Europe, as well as abroad. I do think, on the other side of this, as the strong get stronger, it does further highlight the regulatory environment because it's really starting to show a bifurcation in tech. And when you look at Amazon from a market share perspective, they gain more and more share, puts them further in the bright spotlight. And that's why for them it's a balancing act, as you're seeing, not just in France, but across other areas with warehouses, and especially as they're looking to get further into logistics and freight. And as many companies are struggling today, Amazon's obviously finding success, but that's something that could have another side of it on the other as we go into the coming year.
Finally, Dan, of course, you covered Tesla as well. What are the prospects for this company? Of course, we have seen car sales and car demand just plummet.
I mean, Musk and his red cape yet again continue to be what the bulls are focused on, because as you saw with deliveries in the March quarter, beat lowered expectations. I think investors are bracing for just a disastrous June, just given the Fremont shutdown and the global pandemic. But they're looking on the other side of this. That's why the stock continues to move higher on China, on the prospects there, as well as playing the EV demand. So with Tesla, there's a near term versus a long term. And that's why right now the bulls are winning. And I don't really see anything going into earnings that's going to stop that bull train as they continue to look on the other side of Dark Valley to own this name as a core EV play.
All right, Wedbush Securities, MD of Equity Research, Daniel Ives there. Dan, great to have you as always. All right, well, we do have more on tech in terms of COVID, in the times of COVID, I should say. Later on, we're joined by the INSEE Capital founding partner, JP Gan. That's at 9:40 a.m. in Hong Kong. Just got a bit more Japan data crossing the Bloomberg for you. Producer price index for services in the month of March, that year-on-year figure coming in just missing expectations of 1.6%. We were looking at a gain of 1.7% and moderating from February's levels of 2.1%. Of course, comes on the back of those CPI numbers that were out a little bit earlier this hour, last hour, I should say, just pretty much bang on expectations. Lots more to come. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Let's now get you a quick check of the latest business flash headlines. Alibaba is tightening control of sales of protective virus equipment on its platforms amid claims some sellers are hiking prices. It says only invited members will be allowed to sell PPE on Alibaba.com, and anyone who tries to dodge the rules and make exaggerated claims will be subject to so far unsubstantiated penalties. Online peer Amazon has also been accused of letting sellers gouge prices. The collapse of China's Luckin Coffee has led to a five-fold increase in Asian loan loss provisions for Credit Suisse. The Swiss bank provided about $100 million in margin loans to Luckin before accounting fraud allegations triggered a collapse in the stock. However, even with these losses, Credit Suisse still announced a 38% rise in pre-tax earnings in Asia during its earnings call. The backlash against Zoom is widening, with top companies advising against its conferencing app. Sources say Daimler, Ericsson, and Bank of America are among those banning staff from using Zoom because of security concerns. They join Tesla and government agencies in Asia who have deemed Zoom to be unsafe. Zoom shares have surged in the work-from-home era, and it now claims 300 million daily users.
All right, Sherry, checking in on Asian markets, and we are setting up for a pretty mixed open going into this Friday final session of the week. New Zealand seeing some modest upside, just up about 0.3%, rallying for a second day. We spoke with the finance minister earlier on, who was fairly optimistic going into the partial reopening of the economy that gets underway as of Monday night after this lockdown that they have had that has taken the economy to a standstill. Futures in Australia, we're looking pretty mixed across the rest of the region. Futures in Australia were looking pretty positive, but now kind of looking fairly flat at this point. We are also looking at a little bit of upside when it comes to the start of trading in Hong Kong this after US stocks coming under pressure again amidst a volatile session after jobless claims again. Cumulative looking at 26.5 million jobless claims over the last 5 weeks in the US, as well as news that a great deal of hope attached to one coronavirus therapeutic had come into. We had some news of some poor testing data. Well, coming up on the next hour of Daybreak Asia, we will be joined up next by some great guests in the next hour. We'll be joined by the DWS Head of Index Investing, Luke Oliver, will be with us to talk all about the market's impact of China halting these applications for new ETFs across certain sectors, what that means for foreign investors. So we've got the market open in Sydney, Tokyo and Seoul up next. And in Tokyo, we'll be looking for that first response to what was a pretty lackluster set of consumer as well as producer price inflation numbers. Lots more to come. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
During these uncertain times, we remain committed
to providing the news and data driving global markets
to make sense of this situation impacting all of us right now.
And while we may look a bit different, we stand by that commitment. We're here for you. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Women I talk to. I think Facebook's probably won in a lot of ways.
Running Microsoft was a ton of fun, and it was, it's kind of inspirational.
This is your weekly review of the most important business news and interviews from Bloomberg Television around the world. evening from Bloomberg's global headquarters in New York. I'm Sharian.
And I'm Heidi Stroud-Watts in Sydney. Asia's major markets have just opened for trade. Welcome to Daybreak Asia. Our top stories this hour. Asia markets are facing an uncertain session after reports the leading coronavirus drug has tested poorly. A global rebound has stalled after 2 weeks of gains. Oil maintains its slow recovery after a wild week. Futures gaining in New York, but traders are still concerned about the swelling global glut and the lack of storage. And more moves towards relaxing these virus lockdowns. Malaysia eases curbs. New Zealand will lift them on Monday, but the EU is told it's done too little, too late. All right, let's get straight to the market action with Sydney, of course, Seoul and Tokyo coming online. Sophie Camerodin's in Hong Kong. Sophie.
Well, kicking it off with the movements in Tokyo, we are seeing the Nikkei 225 lower by about 0.7%. This is the economic outlook grows dimmer. The Cabinet Office cutting its forecast for a second time this month, and QE likely in play at the BOJ's upcoming policy decision. Now, we did get data this morning showing inflation slowing again in Japan, with that collapse in oil adding to the drag. The reaction seen in the yen staying. We'll be looking to the BOJ's buying of super long notes today.
Right, and of course, we are still watching the Korea Open as well. Take a look at the Kospi, which is down 0.4%. Of course, we had seen Korea first quarter GDP numbers drop the most since 2008 in the past session. We are still watching out for more earnings out of South Korea, including those of POSCO and Kia Motors. The ASX 200 holding steady. This as we see the Aussie dollar supported by the recovery that we're seeing in commodity prices. Kiwi stocks gaining ground for a second session. We had seen the Kiwi dollar also strengthening after we saw rising crude prices fueling a bout of dollar selling. It's also the last working day before New Zealand eases on its lockdown. U.S. futures under pressure at the moment. They close mostly lower in today's session after that report that a leading antiviral drug by Gilead had performed poorly in its first clinical test. Let's get more on what to expect from the markets. Luke Oliver is head of index investing at DWS Group. Luke, great to have you with us. Of course, we have seen this massive volatility in oil prices, and for the first time, crude going below zero on Monday, rebounding a little bit at the moment. But of course, this has triggered massive volatility in oil ETFs. What's the point of these ETFs if you see this much volatility, and what is the future hold for these exchange-traded funds when it comes to those pegged to the price of oil?
Well, thank you for having me on. Yeah, it's been very interesting watching the commodity ETFs, and seeing negative oil prices is something quite shocking for most people, and to see something negative and then try and wrap that around an exchange-traded fund is quite challenging. But in most cases, most of the ETFs, in fact, almost all the ETFs that tracked oil had already rolled into later futures contracts that were not negative. So that was a surprise to some. And then we've also seen ETFs, considering that they are a new technology or newer technology and a very nimble and sort of the latest technology in fund investing, they've actually adapted already. And we've seen that the biggest oil ETF in the US has already converted its strategy to being flexible and slightly more active. So they're pushing out the number of contracts they hold out into the future, so they're not as susceptible to the front month going negative, which is just a technical issue around the fact that there's so much oil being produced and not enough demand for it, and those futures contracts expiring have led to a glut of oil and not enough storage for it, which has pushed the settlement price negative.
Luke, as we're talking, we're getting breaking news that President Duterte in the Philippines has extended the lockdown in the capital region to May 15th. Again, President Duterte extending that lockdown on the capital region in the Philippines to May 15th. And of course, Luke, as we continue to see this second, third wave of infections across Asia, not to mention some rising infection cases in Europe as well, so much uncertainty in the markets right now. What are you watching in order to find some opportunities as we continue to see volatility all across?
Yeah, well, the first one, I think, as far as emerging markets are concerned, we prefer the Asian emerging markets for the reasons that you've said. Even though there's concerns about second and third waves, we feel that those Asian emerging markets have already gone through what some of the Latin America and other emerging markets have yet to go through. So we see that as a potential opportunity. The second one is the high-yield market. U.S. high-yield corporate debt is a really fascinating place to look at because in both periods prior to this one where high-yield spreads blew out to more than 1,000 basis points, so that's 2002 and 2008, high-yield bonds outperformed stocks over the following 12 months. So we've seen a lot of people moving towards high-yield ETFs in the U.S. to get exposure. And when you pair that with the Federal Reserve Bank looking to also invest in high-yield ETFs, that makes high-yield very interesting to us. And then this one might be a bit more controversial, is looking at China. We think that China remains, a very strong opportunity for investors. And it has actually outperformed last year and year-to-date despite the turmoil that we've had. So China has been a great diversifier in portfolios. It's been very uncorrelated, and it's also performed quite well. And so there is something quite interesting about China in the fact that if the rest of the world in some way, if China becomes more isolated, the fact that its composition of GDP has become a lot more consumption-focused makes China quite interesting, which I think is somewhat counterintuitive given some of the news cycles around coronavirus and so on.
Luke, we have a viewer question wanting to know where you see the long-term prospects for oil. I understand, obviously, you're here to talk ETFs and can perhaps give more context as to what the implications are for inflation and for market indexes in particular. But do you have a response to that?
Yeah. Well, I mean, certainly it's been quite a few years since I ran an oil fund, and these days I focus mostly on high yield and international equities. But I will say that having low oil prices definitely will mean that probably inflation will stay low or at levels that it's been at for some time. I think interest rates will stay low and to zero where they've been recently. And I think that when I think about the U.S. economy, for example, it's not as susceptible to oil prices as it was, say, 10 years ago. So it's not as much of a hurdle. I mentioned high yield. High yield is often affected by oil prices, low oil prices. A lot of the high-yield issuers are oil companies. But what we've actually seen is the oil companies that are high-yield have recently fallen from investment grade and are the companies that are issuing debt at the moment. So we're actually seeing an improved quality of oil issuer in the high-yield space. So it's very mixed. I wouldn't take it as a one direction that cheap oil is a terrible thing for all sectors. As far as how long oil will stay down, that's going to be very interesting, and a lot of that is going to play into there's a dual effect here. There's are we going to be getting the economies back open and back to work and back to consuming, and is Russia and Saudi going to resolve their issue?
How does the Fed's backstop and increasing conversations about direct debt monetization for other central banks around the world play into your calls and your optimism about the opportunities within high yield?
Well, in high yield, the fact that we're seeing the Fed step in and look at high yield and more notably the kind of the fallen angels, we call them, the firms that have become high yield recently out of investment grade, certainly supports those companies, keeps borrowing for those companies stable. There's an awful lot of jobs behind the firms that issue that debt. So that's certainly very helpful. But I think one of the things that I think is actually very interesting at the moment that nobody's talking about, and this is as important for Asian investors as much as U.S. investors, is currencies and how this affects currencies. And I think that there has been an increase in currency volatility, and there's also been an increase in the correlations between equities and currencies. So when that happens, you often get an increase in risk for holding foreign equity investments. And I think that's something that not enough people are talking about. So we really favor the idea of hedging currency hedge. We think you want to be invested in international equities for diversification, but when you do that, you need to be currency hedged when doing so. And just looking at the difference between interest rates, considering most developed countries are very close, if not at zero, there's often not much of a cost to doing that currency hedge. So we think taking that risk off the table is really important. And I definitely don't think many people are talking about the currency exposure.
All right, Luke Oliver, DWS Group's Head of Index Investing. Thank you so much for joining us. We are just taking a look at the 10-year JGB yield below zero with the Bank of Japan QE in view. Of course, we have that meeting next week looking at further measures from the Bank of Japan and the BOJ expected to buy in the super long end today. So we are looking at the Japanese government bond, the 10-year yield there, down the most in a month in terms of percentage points, basis points, I should say, as well. Just one of the indicators that we are watching. Well, still ahead, Kathy Jones, Chief Fixed Income Strategist, will be joining us next. She is with Schwab Centre for Financial Research and will be sharing her outlook for the sector. But coming up next, New Zealand Finance Minister Grant Robertson spoke with us about opening up the borders, rolling out government support ahead of the reopening of the economy next week. Our exclusive interview is just ahead. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
You're watching Daybreak Asia. I'm Karina Mitchell with the First Word headlines. The House of Representatives has overwhelmingly passed a $484 billion coronavirus aid package, even with lawmakers at odds over the next rescue bill. The debate saw members wearing masks and entering the chamber under strict health precautions. President Trump is expected to sign the bill, which is the fourth virus-related spending package since early last month. The UK is seeing the price it may pay for the virus lockdown as output shrinks at the fastest pace in decades. Current and former Bank of England policymakers say the outlook for jobs is, quote, horrendous, with a quarter of the labor market already effectively out of work. UK output contracted this month at the fastest pace in 20 years, but Bloomberg Economics says that may still understate the damage. And Australia has called on G20 countries to end wet wildlife markets over concerns they pose a threat to human health and agriculture. Australia used the group's virtual meeting Thursday to push for changes, but was careful not to single out China, which is Australia's biggest trading partner. The first known cluster of COVID-19 reportedly centered on a wet market in Wuhan, capital of Hubei province.
We have to act as a global community and understand and see if we can mitigate those risks.
And if they can't, well, then we have to understand how do we isolate them from a traditional wet market that is very important, particularly in developing nations, in providing food security.
Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
Right, Japan is stepping up efforts to contain the coronavirus. Authorities are telling people to stay at home during an upcoming Golden Week holiday with a goal to lift its quasi-lockdown in early May. Let's get the latest from Bloomberg Markets anchor Yvonne Mann. Yvonne, so will this work?
Well, it's a tall order, certainly, Sherry. We just heard from the Tokyo governor, Yuriko Koike, proposing the idea where big companies should add vacation days and turn this Golden Week holiday to a 12-day break, calling it stay-at-home weeks. And they're hoping to do so they can lift that state of emergency order on May 6th. But lifting that holiday, lifting the lockdown, I should say, during the holiday could be a risk. This is the most popular time to travel, where families take extra time off to travel to their hometowns or abroad. And keep in mind, Japan also doesn't have any penalties for people traveling unnecessarily. And we've seen a couple of warm days where people did venture out as well. So there is a risk of lifting this state of emergency during this crucial time. Japan has seen a decline in new infections, but given the limited testing out there and a majority of these new cases unknown or with no known links, the extent of the virus is still unclear. Abe, the prime minister himself, saying that the goal of reducing person-to-person interactions by 80% has not been met yet. And Koike also saying and calling for residents to limit their grocery store shopping to once every 3 days because they were getting too crowded. So it's going to be tough to lift that state of emergency order on May 6th.
Yvonne, we also just got news that the Philippines is extending its lockdown. What do we know?
Yeah, so they're going to be extending that lockdown in the capital region to May 15th now. And we've seen that the death toll in the Philippines from COVID-19 has surged nearly fivefold since the start of the month to 462 fatalities. Confirmed cases have also tripled to nearly 7,000 now. So you see the thinking behind why they had to extend this. The government is now also not only trying to contain this virus, but also dealing with the medical brain drain that's weighing the healthcare industry as well, and trying to keep nurses at home instead of exporting them around the world. Meantime, we also heard from other countries like Malaysia extending its lockdown until May 12th, while also easing some restrictions. They're allowing about 10,000 students living in dorms and those away from home will now be allowed to travel during the lockdown. And the growth in new infections has slowed in the country. So the government has relaxed some restrictions to allow a few companies in construction, machinery to operate again, but with a reduced workforce. The government, though, not ruling out a further extension of that lockdown for now.
All right, Yvonne Mann, our Bloomberg anchor there with the latest, and we do just have some more coming through from the Philippines. Duterte now saying that the Philippines is, quote, running out of funds. This as he announces the extension of the lockdown of the capital and the nearby areas to May 5th on account of the majority of economic output to stem the spread of the coronavirus. This 2-week extension for Metro Manila, central and southern parts of the main Luzon Island as well. Those restrictions had begun in mid-March. We'll turn into New Zealand, and the Finance Minister Grant Robertson says the government there will be looking to other industries to pick up the slack in the economy as a prolonged border closures stall visitor arrivals and force some tourism businesses to the brink of collapse. Here's our exclusive interview.
We've still got work to do there, but certainly the two countries, when you look around the world, are two that have done better than most in terms of that. We're some distance off that from New Zealand's perspective. Most of the cases we have had have come in from outside, so we have strong border restrictions in place, and we expect those to stay in place for some time to come. But clearly we would like to work towards, a time when we do reopen those borders in Australia and us have got fairly easy flow of people in any case. So that would be something that we would like to keep working on and looking at, but in order to make sure we've really got on top of this virus, those border restrictions are going to be in place for a significant period of time.
What would that do to your tourism industry and consequently to the rest of the economy?
Well, clearly our tourism industry is going to be significantly affected. It represents somewhere between about 5 and 7% of GDP in New Zealand, and it's been a sector that's been growing strongly over the last few years. So over the next year to 18 months, it will clearly look very, very different, and we're already seeing some businesses within that sector who are either freezing their operations or scaling them down significantly. It's one of the sectors that we're very focused on working with in developing a recovery and a plan. It'll also be a plan that will involve redeployment of some people who work in those sectors and also, support for businesses to change their focus as well. It's an example of where New Zealand will need to be looking to other sectors to pick up the slack. Our primary industries, of course, are still going very well. We're a great supplier of food to the world, and people still need that food. But we've also got to look at how we might fill the gap with other areas of work, particularly around added value processing in New Zealand and advanced manufacturing and so on that can pick up some of the slack from tourism. But there's no doubt that sector will be significantly affected for at least the next year or so.
Minister, government debt to GDP was under 20% pre-crisis levels. What's the appetite, I'm wondering, to push that up? Could it go to as much as, say, 50%?
Well, this is one of the things that New Zealand is well positioned in terms of this recovery. That debt to GDP ratio of just under 20% is very low relative to the rest of the world, and so it does place us in a position where we can borrow more and extend that out, and we will, and we are. The exact level that we reach will be one that will become clear when we get to that budget on the 14th of May. But it will continue to be, I would imagine, at the very low end of international comparisons on this. New Zealand is a robust economy, and we can service debt somewhat higher than where we've had it. One of the reasons we've kept it low is because we have tended to be susceptible to the impacts of global economic shocks and also natural disasters, which we've been unfortunate to have several of in New Zealand. So, as we say here in New Zealand, this is, we do this so we're ready for a rainy day, and it's pouring outside, and so we are now in a position to be able to use that debt position. We'll continue to be careful with our spending, but as most countries around the world have done, we've put in substantial support packages already, and there will be more to come.
Minister, what could the size of the extra government support be? Because your Treasury has released scenarios from 20 billion Kiwi dollars to 40 billion. So could we safely assume that it would be at least 20 billion?
Well, look, those were just scenarios that the Treasury developed as indicative examples of what could happen. The final details of that will be in our budget. As I said before, we're in a strong position going into this in terms of New Zealand's debt levels. It means that we are able to facilitate the kind of fiscal policy that's needed and the fiscal responses that are needed. So we'll make sure that they are targeted towards the sectors that need our assistance, that they continue to support businesses and households to respond, and the amounts of money are eye-watering compared to what countries like ourselves are used to spending, but we are committed to, supporting our firms and our people through this situation. So the sums of money will be substantial, but the final details of that will be put out in 3 weeks' time.
That was our exclusive interview with the New Zealand Finance Minister, Grant Robertson. Still ahead, how Hong Kong's extension of social distancing measures is hitting the F&B industry. Camprade Group Chairman Simon Wong joins us later. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Let's get you a quick check of the latest business flash headlines. Apple is said to be planning to sell Mac computers powered by its own main processors in the coming year, relying on designs from the iPhone and iPad. We're told it's working on 3 chips based on the A14 processor in the next iPhone, with the first said to be much faster than current designs. The plan is codenamed Kalamata and is said to see Apple lessen its reliance on long-term supplier Intel. Amtrak's hopes of breaking even for the first time in its history have been derailed by the coronavirus, with passenger numbers slumping by 95%. That means an expected loss of at least $700 million on an adjusted operating basis in the current fiscal year. Amtrak has cut services by half nationwide, with some routes being suspended. They include the lucrative route between Boston and Washington. Saudi Aramco is said to have hired advisors to review its potential sale of a stake in its pipeline business. We're told it's working with JP Morgan on a deal which could be worth several $1 billion, and Mitsubishi UFJ is also said to have a role. Aramco is yet to start a formal sale process, and our sources say it may wait until the oil market stabilises and the coronavirus pandemic eases. Well, coming up next, seeking refuge in the junk bond market. Schwab's chief fixed income strategist Kathy Jones tells us what her concerns are feeding through to the corporate debt market.
Managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Well, we are getting some conflicting information coming out when it comes to what we're seeing out of the Philippines. Of course, we heard from Duterte just a few minutes ago saying that the country was running out of funds. We are now getting that response from the finance chief, the finance secretary, saying that the Philippines has sufficient cash at this point. So still trying to get some clarity on that, but certainly this is not the first time that Duterte has made that statement. In the past, he's also talked about the possibility of selling off assets to fund this government closure. We have also just heard that the shutdown of the capital and the nearby areas on Luzon Island will be extended into the middle of May. All right, let's take a look at what we're seeing across markets this Friday session with Sophie Cameron in Hong Kong. Soph.
Well, hi, Dave. This Friday, we're seeing Asian stocks losing ground with discretionary and industrials leading sectoral declines, while energy and healthcare are among the few bright spots in the region. Over in Tokyo, the Nikkei 225 resuming losses and set to halt a 2-week gain, while the Kospi is extending declines for a third session. And today we are watching for earnings from names like Kia Motors and POSCO. And Korean shares, just want to highlight that, edging just slightly higher on a report it may get financial support from state-run lenders. Now, over in Sydney, we are seeing Australian Australian shares swinging after a 4-day decline, and Kiwi stocks edging higher but set for the first weekly drop in 5. Now let's switch it out to check in on the yen this morning, just holding around 107.74, and the currency could face headwinds while we're seeing 10-year JGBs below 0, with the BOJ expected to join the QE club as public debt surges around the world, with government borrowing surpassing what we saw during the global financial crisis. Now, Australia clocking a record month of issuance, and today will bring a 2023 bond sale, but the RBA not scheduled to buy for the first time since it began its QE program, and Aussie bonds heading lower ahead of that. And today we are going to be watching South Korean notes, with the finance ministry ready to issue bonds to fund a universal cash handout. Plus, Kookmin Bank also jumping in with a bond offer to support small businesses in South Korea. And Sherry, as virus-driven debt supply is ramping up, South Korean bonds may emerge as the safest bets, while India and Indonesia may be looking more vulnerable in light of their current account deficits. Sherry.
Yeah, Sophie, staying on that debt supply surge, companies hard hit by the pandemic continue to seek refuge in the bond market, where investors have been more than willing to throw them billions of dollars in lifelines. Delta Airlines and Gap were the latest to seek new funding in what was a busy day for corporate debt sales. Kathy Jones is Chief Fixed Income Strategist at the Charles Schwab Center for Financial Research. Kathy, great to have you with us. What's the risk that some of this buying may be indiscriminate?
Yeah, my concern is that as soon as the Federal Reserve announced that they would buy some high-yield bonds and possibly even high-yield ETFs, it's just sort of a rush of money into the market on the assumption, or the mantra was, buy what the Fed is buying. But I think it's clear that the Fed is only buying a small sliver of the high-yield bond market at this stage of the game, and I'm afraid that the rush of money in may not be looking carefully at the fact that we're still going to see defaults and downgrades. And in fact, I think a default cycle in this cycle we'll see a default rate, over 10%, which is typical of a recession. So my concern is it's just rushed a little too far too fast.
What about the fact that European appetite could also be rising, given that the ECB is now accepting junk bonds as collateral?
Yeah, I think the central banks are doing all that they can. It's a logical move since there was not that much in the way of corporate debt for them to absorb, and there are a lot of fallen angels in Europe as well as in the United States, so I think they have to make room for that in their overall plan to support the economy. But again, investors who aren't picking carefully which bonds they're buying may regret rushing in a little too fast.
Kathy, how much structural dislocation are we setting up for in terms of the financial system, in terms of debt markets, once we're out kind of the other side to this, given that increasingly we're seeing policymakers do whatever it takes in terms of extraordinary monetary measures?
Yeah, I think it's so hard to know when this is over. We're all sort of trying to figure out what happens on the other side of it, but we really don't know when that happens. And so the longer this goes, obviously, the more we're going to see structurally that the central banks are owners of a huge proportion of the market. That being said, I think if we think about the financial crisis, the Federal Reserve really did take its time to start unwinding the balance sheet and going back to something that resembled a normal policy. And that's probably the order of things that we're going to see when this is over. They will probably hang on for quite some time to a very aggressive policy and then try to dial it back very, very slowly. And that's going to set us up probably for several years of dislocation in this market.
In terms of what we're seeing in the oil market, does that sort of tell you that there are certain sovereigns that you would be avoiding at this point until we see a meaningful recovery?
Yeah, in the sovereign markets, we've been fairly cautious on any of the commodity producers because obviously this is a crisis that, combined with the oil shock, has really caused those currencies to decline. So we've been sort of avoiding Canada and the Norwegian krona and things like that. But in general, I would say they're good developed markets, but at this stage of the game, we're probably going to see more currency weakness there, and that's our concern. And we're also concerned, again, traveling back to the credit markets, a good portion of the high-yield market in the United States and increasingly elsewhere is in energy. So it's kind of combining between the sovereigns and the credit markets, where the oil shock is having a big impact on a big portion of the market, and we'll probably see the bonds downgraded and the currencies continue to decline.
What about different regions? Because we have heard more optimism about potential opportunity in emerging market high yield.
Yeah, we're not crazy about emerging markets right now. I mean, I think if I want an opportunity, I'd probably look at Italian, BTPs, and looking for the spread to narrow versus Germany. In the emerging markets, I mean, there's big differences between various countries, but my biggest concern there is the big buildup of dollar-denominated debt amongst the issuers and amongst the corporations. And with the dollar continuing to rise, that's fueled even more demand for dollars to service that debt, and obviously that can get very expensive, and the cost of that debt service is rising. And depending on which emerging market you're talking about, country you're talking about, some are really not well positioned to deal with this crisis. They don't have the reserves. It's really having an impact on their exports or their main production. So I'd be a little cautious about emerging markets. I don't think the risk-reward is attractive there yet.
What are some of the risks that you're seeing when it comes to the overall economy and your investing strategies?
The biggest risk is, I think, that we have a double-dip recession, that we come out of this and there's a lot of optimism and maybe risk assets rally, and then we have to go through this process again because potentially the virus comes back and we have to shut down again or go into rolling lockdowns, and this just carries on for a long period of time. That's a scenario where it gets really difficult for the central banks to do a lot more than keeping rates near zero and expanding their balance sheets. And it gets more difficult for governments to continue to expand fiscal policy. So we could see sort of a rolling recessions for a long period of time. For me, that's the negative scenario. And I think we're dealing well now with the immediate shock, and central banks and fiscal policy expansion is really getting aggressive, has gotten aggressive and is dealing with it. But if this lasts a really long time, or we get a cycle of this that comes back a couple of times, that's going to be very difficult to emerge from.
Kathy, according to new research from Nomura and Wells Fargo, over 10% of U.S. collateralized loan obligations have failed their collateral tests. So in that case, are you seeing quite a bit of rising risk in this part of the market?
Yeah, we are. And that was going to be inevitable, I think, given the underwriting standards that we've had over the last several years and the search for yield, have really got a lot of covenant light paper out there. And it's not surprising as we get into a very difficult economic environment that we're going to see some failure there. So as with everything else, I think the approach you need to take is up in quality in everything, whether it's in corporate bonds or in the sovereign space. You want to stay up in quality in terms of credit quality, because this is going to be a difficult cycle for all parts of the market.
All right, Kathy, great to have you with us. Kathy Jones, Chief Fixed Income Strategist at the Charles Schwab Center for Financial Research. Great to have you. All right, we are getting a little bit more clarification, perhaps, when it comes to these comments from the Philippines Duterte, saying that these comments, when he spoke a few minutes earlier, saying that they were running out of funds, he referred specifically to virus funds. We also had the Finance Secretary coming out and clarifying that funding was not an issue at this point. So we will be getting a bit more details on that. Also, just one more line, the Philippines planning a loan program for small businesses. That's according to the country's trade chief. This as we see that extension of that lockdown for the capital as well as nearby regions to the middle of May. We're also getting numbers now for the coronavirus cases out of China, that daily reporting data. China reporting 6 additional coronavirus cases on April 23rd, so a very low number there. 2 out of those 6 new cases for April 23rd are imported according to these latest numbers, and we'll just get these details as to how many asymptomatic cases are being reported as well. Well, coming up next, we'll be reviewing earnings from Chinese insurers, this as the pandemic hits sales and investment returns. This is Bloomberg.
Here's the thing about managing multiple clouds for your business. Things can get a bit cloudy for you, but now there's the Dell Technologies Cloud. A single hub for a consistent operating experience. Here's the thing about managing multiple clouds for your business. Things can get a bit cloudy for you, but now there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever.
Clouds for your business. Things can get a
Street Week.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Action of business and government.
Join me to see the news
This is Daybreak Asia. I'm Karina Mitchell with the First Word headlines. Global virus cases continue to rise, although there are more signs of easing in some areas. However, world leaders are being criticized. ECB President Christine Lagarde told a virtual EU summit that governments have done too little to stem the virus, and what they have introduced has been too late. U.S. cases rose at the slowest pace in 3 weeks, while Spain reported the most infections and fatalities in a week.
The public must understand the inherent risks as governments, understandably, try to release the steam building up in societies and pressing our respective economies. This is not an exit. There is no fast track to the new normal.
The EU economy slumped this month as coronavirus restrictions hammer companies and jobs and leave the single market struggling to stay afloat. An estimate of private sector activity plunged to 13.5 from 29.7 in March, far sharper than forecast and the lowest PMI reading since records began 2 decades ago. The data suggests the economy is heading for a sharp and lengthy recession. Meanwhile, Japan has a bleak view of its virus-hit economy, saying the prospects are the worst since the financial crisis. Japan says the situation is, quote, extremely severe and worsening rapidly as it cuts forecasts for a second straight month and downgrades consumer spending, factory production, corporate earnings, and jobs. Nikkei says the BOJ will discuss unlimited government bond purchases when it meets on Monday. And oil continues its recovery from dramatic sell-offs this week, although the global oversupply still sees huge amounts of crude looking for a home. Futures gained 20% here in New York, with U.S. production now at its lowest level since July. Some OPEC nations have instigated output curbs. Kuwait says it's rolling back production, while Algeria has also said pumping will be reduced immediately. Global news 24 hours a day on air and on Quick Take by Bloomberg. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
Karina, China's top two insurance companies saw profits plunge in the first quarter as the coronavirus hit sales and investment returns. China Life, the country's biggest life insurer, posted a 34% drop in profits through March, while Ping An, China's largest insurer by market value, said profits fell 43%. Let's bring in Bloomberg Markets co-anchor Tom McKenzie in Beijing. Tom, so give us the top lines from these results.
Yeah, Jerry, so both Ping An and China Life saw their profits hit by a drop in sales. Not a big surprise given the coronavirus impact, but also, of course, the impact on their investments and low interest rates as well. So Ping An's net income fell to $3.7 billion from around $6.5 billion the year before. New business value, which measures the profitability of new life and health insurance policies, that fell 24% for Ping An. Investment income, which I mentioned, fell 93%. Again, you had volatile stocks, of course, and very low interest rates. Operating profit, though, for Ping An still came in the positive. When you strip out that investment volatility, that actually rose more than 5%. Over at China Life, they saw profits fall 34%, as you say. Net income dropping to $2.4 billion from around $3.7 billion a year earlier. That was in line with estimates. But here's one key takeaway for China Life, and the analysts are pointing to that this morning. New business, actually, in terms of new business value, actually rose for China Life more than 8%. You're seeing CICC and Citigroup both expecting a tick-up in the shares when they start trading in a little under 1 hour on the back of that new business growth. So that's a line, a silver line for China Life, at least.
Tom, does that mean there's expectations of a V-shaped recovery for premiums?
Well, certainly when you listen to consultants like Oliver Wyman, they do see that V-shaped recovery now. They say that they've been pretty resilient, these insurers here in China. They do see a recovery in premiums, and that is on better sales that they've seen in March, and significant demand as well for insurance protection. People are taking these issues more seriously on the back of the virus. So they do expect the sector as a whole to clock up moderate growth for the remainder of the year. That is according to Oliver Wyman. And over at Bloomberg Intelligence, they see, again, that this China Life's new business value growth being pretty positive. They say it could top 10% this year, again, even as net income is squeezed by those low bond yields. And they also see for Ping An as well an improvement in business value growth in the second half. So the equity markets and the interest rate environment is still going to prove a drag, but there is some opportunity here, it seems, for the insurers.
All right, our Bloomberg Markets co-anchor Tom McKenzie there in Beijing with the latest on those Chinese insurers. We are just getting some breaking lines when it comes to the U.S. department store JCPenney, said to be in advanced talks for bankruptcy financing. That's according to a report from the Dow Jones. We have seen just increasing pressure on these U.S. retailers, right, given the shutdown that we've seen across large parts of the economy. JCPenney is said to be in advanced talks for bankruptcy funding with a group of lenders, in a sign that the troubled retailer is about to succumb to the economic collapse caused by the pandemic. We're looking at discussions being held with the likes of Wells Fargo, Bank of America, JP Morgan Chase for a so-called debtor in possession loan that would keep JCPenney's operations funded during a court-supervised bankruptcy. That's according to people familiar with the matter. The loan package that we're talking about could total around $800 million to $1 billion, some of that money potentially including existing debt, and that is likely to be a syndicated facility as well, so that other lenders could get involved. We could be looking at a bankruptcy filing for JCPenney in the next few weeks. The company did enter into that 30-day grace period after missing an interest payment to bondholders in the middle of April. Well, lots more to come. This is Bloomberg.
Here's the thing about managing multiple clouds for your business. Things can get a bit cloudy for you. But now, there's the Dell Technologies Cloud.
A single hub for a consistent operating experience.